Let's go. My name is Andrew Pivnenko. Glad to be with you in this webinar. I will briefly tell you about my experience. I work with the worldwide software outsourcing and product companies. I have focused on service businesses because I realized that the influence of finance management is on the right decisions in such company is maximum. I associated my mission with finance, and Finbase is a financial consulting agency. For 6 years, we have been doing consulting projects in many companies, and now we are controlling finances of 20 different companies. Also, you can see on the slide, we are a financial advisory board member at Niga Tech family. This is a smart investment fund that invests in global companies and fastly growing them. One thing that has always bothered me about my consulting, how good is my consulting? And I started thinking that when I started counting my results in every company that we worked with. And it turned out that my consulting is for the first years always wins back in the company's profits, which means that in the following years, it continues to win back. Sometimes I see that investments in consulting are returned in 1 to 2 months. So enough about me. You probably wonder, what are we going to talk about today? First of all, must-have checklist of financial metrics of software development companies, which we use in our everyday's work. What are good and average business metrics? That will be our study and one interesting case, and questions and answers. Also, you're welcome to participate in the chat. If you have questions, just write them in our chat and we will talk about it. Whoever listens to our lecture till the end will find out which indicator, accordingly to our study, has maximum correlation with EBITDA. All important indicators have a correlation, but this one is the most stable among all companies. So let's move on. We studied 400 companies, IT companies with up to 200 contractors. Basically, there are 2 categories of companies. Category 1 made 90% of their decisions based on the CEO's intuition, and category 2 made 70% of decisions based on a system of financial planning. Profits of companies from category 2 is 48% higher, and the margin of business is 60% higher than the company from category 1. This study explains why companies need to have financial management to run the company effectively. All growing outsourcing software development companies control these indicators. Therefore, their business has a possibility to grow. Some of them control all eight, and while others control only 1. But I'm sure this is must-have checklist for every outsourced software development company. On this slide, you see 8 metrics. Also, which tool you use to get this information and who is responsible, which department. You see here, finance department, delivery, sales, somewhere sales marketing, and that's all. So cash flow. Cash flow is a flow of all your transactions, which you can see in the cash flow report, and the bank and your cash transactions. Accounts receivable is debts of all your clients that you have to receive in time. Net profit is incomes and all expenses that we can find in the net profit and P&L report. GPM percentage is gross profit margin. Com percentage is a percentage of your commercial hours. Some people call it utilization or billability. Overhead per employee is an amount that you spend and divide on every billable contractor in your team. Plan is the forecast of the company, and sales and marketing profitability is the efficiency of all your sales and marketing investments. Let's move on. Search for every point. If you don't analyze finance of the company in details, then the company equals a black box. You check just what you investment and what you returned. In this case, we can lose 29% of marginality. In order not to lose profit, we began to analyze and manage all cash flows that are moving through our company, clients, overheads, vendors, and only this step leads us to make profitable reinvestments and grow our business. Hello? I hear somebody. Maybe we can turn off. Thank you. So each of these indicators reveal a vital aspect of a company's cash flow. Therefore, they should be monitored regularly. Let's go into details to understand the meaning of every point. And after that, we will have a case with these metrics. First one, cash flow. The debt of the company comes precisely according to this report. If there is no money, there is nothing to pay wages. We have to react quickly on this report, and we always avoid the amount of free cash flow here. It shows how much the money balance has increased compared to the beginning of the month. We will check every expense category in our today's case in the second part of the lecture. So let's move on. Accounts receivable. We control such usual metrics as everybody: invoice date, scheduled receipt with dates, amount of overdue payments, average payment term, and that's all. About P&L. P&L is a control of efficiency of a company work model. How do we do client projects, and how do we use back office support? These highlighted metrics in P&L are critical for any service businesses. Those are revenue, GPM company percentage, overheads, total expenses, investments, and net profit. We set targets for them and track every period, every month, every quarter, and every year. Gross profit margin is a difference between project income and project expenses. Shows how much money is left in the company after the project. You see in an example, whole column is the revenue 20K, orange part is the direct cost 10K, and the blue part of the column is margin 10K. Direct cost in such business, direct cost of the project is compensation of a billable team on this project, sometimes soft and sometimes devices bought only for this project. GPM percentage, GPM ratio, characterizes the efficiency of using resources on the project and the added value for the client. Let's move on. Sometimes companies don't analyze non-billable delivery costs like bench, vacations, sick leaves, inner projects correctly. We cannot divide them between projects. And those companies who do it make wrong decisions. We always count it in metric GPM company. It consists of project margin of all projects and non-billable cost, which we don't divide in every project. Somebody called this metric DPM, delivery profit margin. So that's all. Let's go to commercial hours. Utilization, billability, or percent of sold hours of a billable team. We often see this pattern in outsourced software development companies. Billable hours takes near 70-75%, inner project spend in such takes 13 to 18%, and vacation sick leave takes 12%. To control this metric, you have to divide all hours in specific elements, plan, analyze every month, and set targets. Some companies have bonus system of a delivery department based on this metric, commercial hours. If company has 60% of commercial hours, in practice, I see the company's profitability is near break-even level. That's about commercial hours. Let's move on. Overhead per employee is calculated as the full overhead of the company divided by count of billable project staff, FTE. We call it full-time employee. You can grow, but if your overheads are not managed, they will eat up all profits. This metric is usually between $750 and $1,100 in companies who manage their expenses well. Let's move on. Forecast. If you fail to plan, you are planning to fail. These are two ways how we can check if the plan has been achieved. First one, check the P&L figures that we planned with the actual ones. Pay attention to large deviation and why this happened. And the second one, we build an operational plan for the next 3 months based on targets and how and see how realistic it is to reach the planned figures. Let's move on. Sales and marketing profitability. Investment in business must be calculated. Then we can understand the effectiveness and manage them. We also understand that LTV in the service business must be higher than customer acquisition cost. But not all companies pay attention to this. LTV and customer acquisition rule is visible on the slide, left part. LTV is profits received from clients, and customer acquisition cost is the cost of marketing and sales to find and sign the contract with the client. This is rather difficult indicator to calculate, so we rarely calculate it. Once a year or every 6 months. So let's move to our study and the case. If you have questions, you can write them in the chat. During my career in financial management, I have communicated with a lot of CEOs, managers, CFOs of software development companies. If big companies in other industries can compare their performance reports by the public companies, there were no benchmarks for software development market, which made it impossible to compare itself with the industry. A team of like-minded people and I decided to fill this gap. We made a big study of software development companies' metrics. More than 70 worldwide companies gave us their management finance data. We checked it and counted metrics. Full confidentiality and anonymity of data is ensured by NDA. So for work, we use only average numbers. Our study contains of average indicator, highest indicator of leading companies, and the lowest for the outsiders, and the benchmark. Good benchmark is an indicator that I see as a target for top companies coming from my consulting experience. And you may disagree with this opinion, but we see these metrics as a targets in a lot of companies, so they use them. Let's analyze the case of imaginary software development company. Suppose it is called Finbase Development. It is a standard outsourcing development company with the different types of projects like fixed price, outstaff, time and materials, like that. This company has 64 full-time billable team and 20 non-billable full-time specialists. This company has clients from Europe and the USA. This is a simplified case for general understanding the situation in a company. So on this slide, we see that monthly income has positive growing trend. Here, the company spends almost half of its income on a billable team and sometimes hires outsourcing, like we see in April. Then we see GPM of the company and GPM company percentage. There are quite high costs for 23K for the administration team. Have an office for 6K, small office expenses, IT infrastructure costs, online like online services, servers, and IT infrastructure team is not high, but high sales and marketing costs. We see not high costs for HR team, their online services, and in May, we see there was most likely kind of corporate celebration. Recruiters and their monthly costs are small. Legal and finance and accounting costs are also not high. Bank charges monthly about $2,000 per month, and taxes from 2 to 4K per month. Also purchased equipment for the company for 22K for these 2 months, maybe some laptops, MacBooks, and as a result, Finbase Development received 37K net profit at the end of 3 months. All figures excluding VAT, payments, bonuses to the back office team are divided by each function, like administration, IT infrastructure team, sales and marketing team, HR team, recruiting team, and legal and finance team. Please write to the chat what you can say about the reporting of such company. Is it great, okay, or bad, and why? We will wait a minute for your thoughts. You can write in English or in Russian as you want. So, what do you think about this report?
Report is not bad, so I will ask. I will challenge one question. So,
Okay.
what should be, according to your presentation, You studied about 280 companies. So what is a minimum metrics for a company to be on a healthy level from billable utilization point of view? So how many percentage should it be?
The healthy rate is 75 to 85%.
So
it's an average.
It's an average
for average company. We will see it on the next slide. This metric.
Andrew, I'm not sure if it's just me, but I think we didn't hear you well.
Wait a sec. 1, 2, 3. Do you hear me?
Yes,
Hello?
now it's good. Now it's
Okay.
good.
Okay.
If you maybe can repeat the answer. I'm not sure if everyone else got the message.
We will see this healthy rate in the next slide, so we will talk about it again. But these commercial hours in some companies can be lower than the average because of the work model. For example, boutique companies have a little lower. I think we have clients that have a boutique model, so they have this commercial hours metric lower, near 60 or 65. But this is unusual model, so we will talk about average things today. Indicators look good. Okay, horrible net profit. Yeah. Thank you. So let's go. I'd better tell my thoughts in comparison with basic metrics on a chart. So we will compare them. Here you see how much percent of its revenue the company spends on each expense category. All percentage of GPM, you see 38%, total overheads 30%, and EBITDA. In the next column, you see the numbers from our study. Market average of companies from 2 to 80 billable people in a team. This is our study. And in the next column, there are big amounts of differences that I noticed and pointed out. There are 5 important differences that I suggest checking at the chart for better understanding. You may notice that we are using EBITDA category instead of EBITDA without letter T. Is earnings before interest, depreciation, and amortization. In the study, we wanted to remove all processes and nuances of optimizations and deferred taxes in order to really compare companies from different countries. So we use this metric. Let's move on to the chart, benchmark check. First, the important indicators. Red one is Finbase development, and green one is market average 20 to 80 billable team. You can immediately notice that this company, from our case, has low GPM. 38% against 45% of market average. This usually indicates problems with sales rates or in delivery team. About overhead, it's slightly above market. And EBITDA is well below market, 7 to 8%. Let's look into details of overheads now on the next chart. In this chart, we see comparison of every expense category of Finbase development and market average. A fairly high rate of administration cost. We see it here. A rental cost below market, most likely it's a good sign. We see at the market average level, office expenses, IT expenses, HR, legal and finance, bank charges, and taxes. But the marketing cost is much higher than the market, and recruiting cost is much below the market. We would need to understand each deviation in more details. First one, commercial hours. This company, from our case, Finbase Development, has 64%. We see that market average 20 to 80 billable team has 75%, and a good benchmark 85%. A healthy rate, as we see in companies, is from 75 to 85%. More than 85% is excellent indicator. An interesting moment from our study, those who have not measured commercial hours have GPM on average 10% lower. In our case, Finbase Development also didn't calculate and manage this indicator, and it turned out to be below the average market. I think this is one of the reasons of low marginality. Further, the delivery department, they need to understand the reasons for such a figure. Let's move on. This is an average recruiting period for billable team from the date of recruiting application to the first working day. In our case, we have 50 days of recruiting period. Market average, we know from our study, is 36 days. And the highest indicator from our study was 14 days. Sometimes I meet such an indicator as a KPI for recruiting department in the client's companies. As we remember, in the case Finbase Development, recruiting costs were quite low. And according to the sales team, they could not close a part of the client's contracts on time because of slow hiring. So it's a problem. Let's move on. Revenue growth per year percentage. In 2021, the global software development industry grew by 7.3% against the predictions of market decline. If a company grows slower than the market, then in some sense it stagnates. In our study, the average growth was 43%, and the fastest growing company was 200%. So it's a triple growth per year. Finbase Development, in our case, has almost no growth, only 2%, as you see on the chart. Let's move on. Customer acquisition cost, CAC. All costs of finding clients, signing contracts divided by number of new clients. We see on the slide that Finbase Development has $3,500. We see that average cost for new customer in this Finbase Development is twice less than average figure in our study. It tells us almost nothing, but the main thing is that this indicator was lower than LTV. I see a healthy indicator in the market when LTV 3 times higher than customer acquisition cost of this company. Let's move to LTV. Lifetime value. Net profit for new projects and upsells, excluding the cost of sales and marketing. In this company, LTV for 2021 is almost equal to customer acquisition cost. which indicate the low efficiency of sales department. So we see Finbase development LTV 3,700 and customer acquisition cost 3,500, almost the same. It's a bad sign. About MRR, monthly recurring revenue. It's average monthly income received under contracts with monthly long-term payment, more than 6 months, divided by total income. This indicator, according to our study, had the highest correlation with EBITDA compared to all indicators. We see that Finbase development MRR is 60% and it's below the market and good benchmark. Market average from our study was 73% and good benchmark is 83%. In this case, it is possible that some of the clients are brought personally by owners and not by sales department. This may explain such a low indicator. Indicators of LTV and customer acquisition cost. Also, this company need to find out the reasons for the low efficiency of delivery and marketing and recruiting department. So we have disclosed only part of the reasons that lead to low business growth. Companies that have these indicators at the benchmark level or higher are capable of growing faster than the market and even 2 or 3 times a year. So this is all about metrics, and that's all. I wish you to reach new financial goals and hails. And if you want to get in touch, my contact's on the screen, and you can write your questions about the numbers, because I told a lot of numbers. We can check something about them. Also, I wanted to tell you one additional slide about MRR. In our study, there are 72 useful indicators that we did not have time to talk about today. Also, I wanted just to show you what our research looks like. We described each indicator in the following format, like reference, explanation, conclusion upon indicator of consultants or head of departments from 4 companies of 2 categories, 20 to 80 billable team and 80 to 100 billable team. Sometimes they have different indicators, different highest, lowest, and benchmark indicator. So we use only one part for each company from each category.